Welcome back, guys. This is President Block Academy. So today we'll be talking about risk management in crypto trading. Risk management practice capture how you intend to manage your risk when trading. They protect you against downside of your trades and keep you in control of your lose. The rules will not only protect you, but they will also help you to make the desired result when the right crypto trading strategy are in place. Yes, risk management helps crypto trader in order to prevent them from losing their capital whenever they are trading. Most of the time, whenever the trade is like against them or downside of them. Now, there is no doubt that you will experience negative events when trading cryptocurrency. By negative event, we mean trade that goes against your desired outcome. Yes, there are a lot of time that crypto traders you would have probably 100% assurance that okay, this trade I want to go into will give me a massive profit, this and that, and at the end of the day, it might give them profit, and at the end of the day it will go back and it will go against them, and it will clear off probably their portfolio. You will know the reason why I said clearing off their portfolio right now. Now, risk is normal in trading. Every crypto trader takes risks. Crypto futures traders take small risks because they tend to use leverage regularly. Now, not following the risk management practice affects your trading balance, and you can even lose all your capital. Yes, like I said earlier, you can even lose all your capital. But now, I'll be telling you guys 8 skills, probably 8 crypto risk management practice that you must practice before you start trading. These 8 things I'm about to tell you will really help you when we are talking about risk management. Because when people are saying risk management is not just something that you can buy somewhere or a application that you deploy on your trading app. No, it is something that you should have. It is something that it should be on your brain. It is something you should be able to implement. I don't know if someone is getting what I'm saying. It's something you should be able to implement, not that you just have it on your app, probably risk management app, and you come and deploy it on your trading. No. So now, with these 8 things I'm about to tell you guys, this 8 thing will help you in your trading. It will help you reduce what we call massive lose. Though you might lose, but not as much as those people that did not have idea of what I'm about to tell you. Yes, a lot of people don't have idea of what I'm about to tell you right now, and if you go through them, you see that most of them they are not successful when they are trading. And it is this set of people you will meet, and they will be like, crypto trading is very hard. If you don't do this, you will do this. It will take all your money. It will do this, blah blah blah. This set of people that are saying this don't have knowledge about what I'm about to tell you right now. But you listening to this video, you watching this video, listening to me right now, if you are able to understand these 8 things I'm about to tell you, and you are able to implement them, you see that you'll be 90% better than them. Now let's go. Number one, have a solid trading plan. One of the biggest mistakes you can make as a trader is starting a trade based on your guilt feelings or your instinct. We can't deny that you can get some positive results this way, but it can only be a result of luck and nothing more. Yes, you trading without any plan. You just open your trading app, you go, you do you view some pairs, you click on, you buy, you short, you do this, you do that, and at the end of the day, it gives you some profit. You think that can be just of a luck, and sometimes you might do that and it might be a total failure for you. Now, those people that will be like, trading is not good, don't trade. Most of them, they don't have any trading plan. They just they'll just go to their trading app, they'll just start navigating up and down, doing this, doing that, buying, selling, Probably they'll make profit today, tomorrow they'll lose it. So yet tomorrow they'll make, tomorrow they'll lose, today they'll make, tomorrow they'll lose. And at the end of the day, they are not making any money at all. Now, you setting a trading plan helps you to reduce your loss, reduce your lose rather, helps you to reduce it. And this is part of risk management, because you setting a trading plan, there are a lot of things you have to set along with it. Now, let's continue. Number 2, only invest what you can avoid to lose. Yes, you only invest what you can avoid to lose. This is an often overlooked aspect of trading, because many traders wrongly believe that nothing can happen to them and they have everything under their control, which is not so. You only invest what you can avoid to lose. You don't just invest every of your money or every of your portfolio because you want to trade and you want to make it big. You want to make big out of it. If you know that out of your $100 portfolio, you can only avoid to lose $5, then you can use that $5 to trade. You should know that this $5 I'm using to trade, after probably if the trade goes against me and it takes off my money, I'll be happy and glad that okay, it takes only $5. And probably if the trade goes on my way also, I'll be glad that okay, I only lose $5 and I use this $5 to make another extra $5, and I'm happy now I have $5 extra, probably $5 profit. So you should only avoid what you can lose. Number 2, size your position. Yes, this idea beyond sizing, position sizing, is that you should measure how much you risk per trade. You should not risk 100% of your capital on a single trade. Yes, why will you risk 100% of your capital on a single trade? Because someone somewhere told you that this trade is legit, is real, that it will go on your way 100% sure. And because you hear something like that, you went ahead, you take all your $100 capital or $100 portfolio, you place it on that trade, and you start trading, and at the end of the day, the trade goes against you, your money is gone. So this set of people that don't know about all this are those people that you say that they'll start telling you that don't trade, trading is not real, trading is gambling, because they don't have the knowledge. Why will you take all your portfolio to go and trade? All because you saw the signal somewhere, or probably a big person, a big influencer, a big mentor of yours told you to go and trade, and you use all your portfolio to trade. It's not done that way. It's not done that way. Now, number 4, limit the use of your leverage. Yes, as a futures traders, you should always limit your leverage. Now, leverage lets you trade using borrowed capital, which is 20 years, 30 years, 40 years that you used to adjust. That thing that you used to adjust, that's what we call leverage. Now, this leverage lets you use borrowed capital. And as a result of this, your profits can be magnified but so your loss also. Same as like your profit and your loss can be magnified. The larger raise the latter raise the needs to understand how leverage works, its impact your trading results, and how best you can manage it. What this part is actually saying is that you should always limit your leverage. If you go to your Binance, if you click on that leveraging side, it will tell you that using higher leverage than 10x increase your liquidation. That means if you are using higher leverage, that means you are borrowing more money, and you borrowing more money from them, it can easily lead to liquidation to your own account. Because sometimes if your account do not meet up with the borrowed money, it will have to take all your portfolio and gone for good. Only if the trade goes against you, rather. But if the trade do not goes against you, you also make money with the leverage also. But it's not advisable you using larger leverage. You should always limit the use of leverage. Number 5, always calculate your risk ratio reward. The risk ratio reward refers to the risk versus that potential return expected from a trade. You should measure the risk ratio reward of a trade before executing it. If you determine the potential results against the risk, you're more likely to go for trade with higher probability of success. Yes, probably during your trading plan, you have a lot, probably 5 to 6 trades that you've set ahead that you want to trade on, and you calculating all these trades that you see here, you notice that this trade particularly will give me that you're having 100% assurance that this trade is going to, if I take this trade right now, it will definitely go my way. If I take this trade also, it will definitely go my way. If I take this trade, I'll be having 2 minds on it, probably to go my way and to go against me. Now, risk ratio rewards let us know that you should go for that 2 trades that you see that it will go on your way and you make something out of it. Yes, it says you are more likely to go for trades with high probability of success. Number 6, sorry. Use of stop loss order. The stop loss order helps specify an existing point in market. It limits your loss when a trade goes against your prediction. You will have loss at some point and there is nothing you can do about it. You can control the loss by using stop loss order every time you trade. I always tell my students that stop loss is even important than take profit sometimes. Yes. Now, stop loss is very, very important to the extent that if you don't use stop loss when you are trading, you just see that your account is gone at the end of the day. You don't have anything in your account. Now, this set of people that will be like, don't trade is gambling, and they don't know anything about this I'm saying right now. How do you expect them to trade? How do you expect them to start making money when at the end of the day they don't even know what stop loss is? All what they add is that if you are trading, you will make money, and they'll download the Binance account, they'll deposit and they start trading without even knowing what stop loss or anything is. Now, if they start trading and the trade start going against them, they don't know anything to do, they don't know what to do because they did not set any stop loss, and the trade goes against them to the extent that it enters their portfolio and take all their money. Now, imagine that. So stop loss is very, very important when you are trading. Always set stop loss in order to specify an existing point in market, that if this trade is going against me and it reaches this particular point, just take me out. That is the usefulness of stop loss. Now, secure your trade with take profit. That is the opposite side of stop loss. Stop loss, the opposite side is take profit. Take profit is just like take profits work similarly to stop loss, with the main difference being that it is used to secure profit and not stop a loss. The tool is designed to take profit when the price reaches a specific point. Yes, probably if the trade is going on your way and you say, okay, when the price reach up to this point, just close the trade for me and give me my profits and my money back. That's just it. Now, the number 8, the last one, have realistic expectation. This one is very, very important. Having realistic expectation is the key to managing your risk. You can't make a 40% monthly profit without risking too much of your capital. It's not possible. Having such a goal will also make you overtrade or use too much leverage, which I say using too much leverage is bad. It might lead to liquidation, which could lead to massive loss. Setting more realistic goals will help you give control over trading emotions like greedy, fear, and hope. Now, let me explain this part for you. There are a lot of people that they want to trade like this. They will be like, I must make $20 today, $20 tomorrow, $20 next week, $20. They'll have that at the back of their mind. Now, all what they'll be doing today, right now, is for them to be able to make $20. And for them to be able to make $20, they will have to be investing big, using higher leverage in order for them to make up to that $20 or probably $50. And you know the crypto market is volatile in price. It goes up, it comes down. And at the end of the day, you're making big lose. Big lose. Because what? It doesn't go your way. You don't have any trading plan. All because you want to start making, you've set a target for yourself. Although you setting a target is very good, but set a target that is more realistic. Like it is more realistic. Don't state a target that is unrealistic. I don't know if someone is getting what I'm saying. Set a target that is more realistic. Don't set a target that is unrealistic, that you can't even meet up with, in order for you not to start using higher leverage or start using big capital to trade. So that will be all about risk management. If you can be able to practice all these 8 things when you are trading, you notice that your method, like the rate you'll be using to lose in crypto space, probably in crypto trading, will reduce to the ones that don't even have any idea of these things. Because what, they'll just be trading. Imagine someone that don't have any idea of only investing what you can avoid to lose. You know you have $100 account and you want to use $50 to trade. Now tell me, if the trade goes against you and it clear off that $50, can you avoid that? It will be a massive loss on you. It can even cause sickness for you. But because you have this knowledge right now, you should know that if I want to trade, at least I can avoid $5, probably $10, $20 from my $100 account. So that is that about risk management. I hope you find this video helpful. If you have any question, kindly comment below. And if this is your first time watching our video, kindly subscribe to our YouTube channel and don't forget to turn on the notification button in order to get notified when we are dropping another video. See you next time.